into this. I'm Avi. Going to do it.
I'm Audi. At software. In software too.
Yeah, so we think Caesars is a compelling long opportunity. $52 target price, 25% upside. Really kind of strong margin safety. Risk reward to 2.66 on 18-month time horizon, right? We have high conviction variant catalysts on the three main segments. First, the online sports betting segment. We think hold rates are going to continue through the investment horizon. Two, we have upside to street estimates on the Vegas segment, primarily due to strong occupancy. And three, we think that the regional segment is overpunished, and there's a key tailwinds there as well, right? And where are we getting kind of that upside? It comes from our fundamental research process. That has to do with, obviously we looked at some third-party data, we looked at web traffic data, we did some ticket scrapes as well as foot traffic data. We engaged with the buy-side network. We spoke to a hedge fund that actually engaged with management the same week that we had that call. And finally, we did some third-party.
Cool. So just touching quickly on the business here. Caesars is your typical casino business. They have trophy assets in Vegas. They have a diversified regional portfolio and a growing online presence, right? Also, highly leveraged stock, right? Over the last couple of years, we've seen multiples come down 7 times. They're trading at a down to peers, and the stock has slid over 50%, right? Why does this happen? Again, Caesars is highly levered, highly correlated to the inverted 10-year yield curve. There's also been a lot of concern about the consumer. And we also believe hedge funds have been long online gaming stocks and been using Caesars as a funding tool.
Yeah, so onto our first thesis. One of our primary variant views is we think there is underappreciated leeway in the online segment. Primarily, we think a big mix shift induced hold rate expansion will significantly drive upside to incremental EBITDA. Street is modeling 8.5 times long-term hold rate margins for Caesars versus 11% of comps, leading because of structural worse bet like technology. However, we argue the opposite. We think if you delve deep into the economics and look at the technology, the result is because of mix shift. Remember, Caesars has historically omitted same-game parlay technology and hasn't been that involved with parlays, which had specific incremental hold rate margins at around 30% and 15% versus single bets at 5%. So as you shift towards that due to the recent acquisition of Zero Flux, which allows for same-game parlay optionality, there can be a significant ramp in terms of hold rates. And we back up this SGP ramp using 2 key scrapes. First is ticket scrapes. We find on this online betting tracking platform that there's a significantly uptick in SGPs as a percentage of total betting volume on Caesars. And more importantly, if you look at the promo skew on the Caesars platform itself, you see significant uptick in recent weeks in terms of that focus. And this allows us to pencil in that over 10% hold rate by the end of 2025, which is around 150 bips higher than current consensus. Moreover, we see significant opportunities in inflection. Remember, the market tends to be pricing in their online sports betting platform as a terminal value zero, a melting ice cube. We believe there's significant leeway here because of 3 key tailwinds. First of all is S&M roll-offs. Remember, in the S&M environment, there are significant opportunities here for Caesar because of their brick and mortar exposure, as well as their growing loyalty program. Secondly is strong penetration in recent new market opportunities, such as North Carolina. During scrapes, we find over 9% penetration. And even more interesting, looking through Pickett, we see other markets, there's significant acceleration in terms of betting volume. And then finally, in terms of multi-books, our third-party channel checks are indicative of growing strength in terms of people using multiple books. And this is extremely important as average transaction volume is extremely correlated with multi-books, which would allow for significant growth for a platform like Caesars. And then we kind of bridge these levers to forward 2025 digital EBITDA of around $500 million, which is in line with our buy-side engagement.
For our second thesis, we illustrate 3 core segments that bridge us to large variance to consensus. The first is a strong and unparalleled event calendar over the second half of the 2024 fiscal year. This includes a visit to Caesars by Adele and big sports events such as the UFC right across the street in the Sphere and the big F1 race as well. In order to couple this, research that all data that suggested that compared to previous COVID-19 numbers, we are seeing large increases in I-15 traffic and N-plane and D-plane numbers as well. Second, we believe in the biggest bubble. That is that non-gaming revenues are actually outpacing gaming revenues and makes us a recessionary and consumer discretionary resilient platform. Third, we believe that the street is mismodeling hotel supply shortage. Because of the Tropicana and Mirage closures, we are seeing a 5% supply shortage that caught the tail end of the first half of the fiscal year, and we will really be able to illustrate this third and fourth quarter of this year. As a result, we are modeling occupancy at around 98%, which is delta to consensus, which is around 96-97%. Moving on, we wanted to see how this actually impacts Caesar. In order to do this, we regressed Caesar's historical quarterly revenue to web traffic data on Caesars.com, which reflects our bookings. We found this is actually a statistical significance value of around an R-squared of 0.81, which is actually very, very correlated. As a result, we are predicting a Q3 revenue beat and additionally lapping very seasonally weak comps, which will in turn set up a very good earnings revision cycle and add a lot of pricing movement for the Caesars.
Yeah, so jumping right into the final thesis, it has to do with the regional business, right? So sell side, university do not like this for three reasons. One, it has exposure to macro and kind of has a negative view on macro. Two, there's a belief that, they're actually turning share, they're losing share. And finally, they just think like year over year, comps have kind of stagnant, right? So we looked at each one of those things individually in a top-down share build using, very simple Bloomberg data. You can see it's relatively stable, around 25% over the last few quarters. So we don't really think that's a big issue. Two, on a relative basis, to Penn, as well as Boyd, which have large casino regional portfolios, you can see that they've actually outperformed on a year-over-year basis, right? Kind of going back to macro, right? Obviously, as I mentioned, it's low single digits. Actually, in reports, it's down 1% year over year. But when you zoom out and look at the trend growth, it's still overwhelmingly positive, right? So relative to 2015 levels, the regional casino market is still growing healthy, right? So I think they're kind of almost over analyzing, kind of the recent slowdown. And on a long-term basis, we definitely underwrite, this to be an attractive kind of market to invest in. The final thing is competition, right? So we think there's a lot of barriers to entry. One, obviously, to open a new casino, you need a lot of regulatory kind of approvals. And the second thing is that, there's almost like a mismatch of supply of casinos as well as kind of the demand for casinos, right? So you can see that, revenue per regional casino is actually going down, but the number of casinos is increasing. And this is kind of well documented in a lot of trade pieces for regional casinos. And that's why we've seen kind of the velocity at which new casinos are opening, particularly in 2024, has decreased pretty rapidly, right? Just zooming out, what does this mean for our pitch, right? If you look at the bear case of the regional business, if we assume a contraction of 5 to 10% of the regional business on a revenue basis, you still get $15 to $20 per share for that part of the business, right? So this is what really drives our margin to safety, and it goes back to what Ali said. It's already kind of trading at a trough multiple, and it's accurately, I would say, priced into the stock already.
Right. Now, in addition to our theses, I just want to touch on potential drivers to our valuation, right? We talked to Buy Side Network, and we feel confident that in the second half of this year, there will be considerable asset sales by management, and this will coincide with roll off of capex investments. And as Caesars is highly levered, right? We're going to see rate continue to come down, and that's going to be reductions to interest expense. And so really see this upside of getting from about $1 billion to 1.5 billion in FCF in the next kind of 12 months. Okay, right. And so ultimately, I think we have an 18-month kind of horizon for our pitch. These are kind of things that are all kind of compounding at the same time.
Yeah, so just jumping into variance, I think as Aiden mentioned, what I was trying to get to there is that we really think that we can play for the earnings revision cycle here. Throughout that 18-month horizon, there's going to be catalysts that reveal the strength of this business, right? So where are we varying again? Just zooming out, upside to street Vegas estimates that's coming from our occupancy relative to street, and then we also have upside to the digital revenue, and that has to do with the hold rate they mentioned, and both those two things kind of coalesce into upside to both EBITDA and free cash flow, right? Very simple. Yeah. So also just kind of touching on valuation here as well. I would just say one thing is there's multiple return levers for this opportunity, right? So in addition to the upside to numbers that we just kind of outlined, we also see a potential re-rating as a narrative around this stock change, right? So we do some of the parts valuation, and you can see we have 25% upside to the current price of $42. And if you solve out actually for what is the brick and mortar business actually trading at? It's trading at just under 7 times, right? A significant discount to a lot of the other brick and mortar casino competitors, right? So that's really what's driving our 2.66 risk reward, and the reason we think this is an attractive opportunity. I think one last thing that I would kind of mention on setup is there's 10% short interest as well, and that long online gaming short kind of brick and mortar trade that's kind of rolling off. So as this earnings revision cycle kind of happens, the incremental buyer could very well be those shorts covering. So that's why I think, overall, there's a lot of catalysts that make it an attractive investment. Great. Thank you. Questions?
On the Zoom, questions? So they telegraph the asset sales. There's the sharehold, you did some interesting work on the misperception of hotel supply. What do you think is going to close the gap on the market missing the opportunity here in Caesar?
Yeah, I think like the key thing, honestly, like where we have the most variance is going to be the sports betting business. And once it hits that 500 million EBITDA mark, like I think people are gonna like kind of start to view it as like a key segment of the business. Like Caesars is still like viewed as like, okay, like this is brick and mortar business and they're trying to do this sports betting on the side. But once it hits 500 million EBITDA, like that's a pretty significant kind of mark. And I think that that'll form some multiple good areas.
Adding on to that, I think that sell side sees digital as something that, isn't exactly the majority of the EBITDA share of the overall company. And as a result, any re-rate wouldn't really move the needle. But what we see is that by disproving that this space is like not a duopoly of just Flutter and DraftKings, we can actually change that narrative. And as I talked about, like with strengthening our hold rates, inflecting market share, we'll actually be able to move the needle and show that, like prove to the incremental buyer that we no longer are the.
You just talk about where you got the idea from?
Yeah, didn't you have a class?
Yeah, I took a restructuring class last year, and we kind of read the Caesars book and documenting the famous bankruptcy that the company went through, and I've been keeping up with the firm, I guess, since. And
yeah, I would add on to that. Like this idea has been written up like a lot, and I think like we did a lot of work, like in addition to a lot of those write ups to really like drive home like the proof point on the digital segment. Like we did a couple of regressions, we did a couple of data scrapes as well. So we really like that just added to our conviction overall in that business becoming like a very significant player in the space.
Question for you. What's the return on capital right now? ROIC for the company?
Yeah, honestly, I don't have that off the top of my head. You
The
guys?
second question probably can't answer. What happens to our ROIC if digital works?
Right. Honestly, I don't have that off the top of my head. This is the model. We could get it back to you though.
Did that feel like an important question?
I would say like in general, probably not, because we're honestly we're playing for like that full year 25 like earnings revision. So we weren't really thinking, I would say, as much with regards to the long-term ROIC trajectory. What I will say is that like just from a technical perspective, like the digital business has like really good free cash flow conversion. Like that's just the quality of like.
Shouldn't that be a better business from a capital perspective?
Yeah, it should.
Shouldn't that make the whole business a better business?
Yeah. So like it would be like a kind of upward pressure on ROIC.
I don't know that I call that upward pressure. That might be a lift instead.
Right. Yeah.
That's usually good.
Right. Yeah.
All right, I'll take the bait. On the digital business, the 500 million, walk me through that. So right now, I think it's running flat to slightly negative. Maybe it could be even slightly positive. It's very sensitive to promotions. Flutter just had an analyst day that was fairly bullish for the overall industry. So can you walk me through how the digital business goes from flat to nearly 500 in a matter of 6 to 9 months, which would be very impressive.
Yeah, I think like one of the main things to consider is that you want to look at hold rates. So we're basically seeing like upticking from like the current like 7-ish, 8% all the way up to 10%. I think it's like pretty valid, like the way in which we're able to reach this. I think like in terms of the path, like if you look at like their current like mix shift of like betting, a lot of it is like single bets, right? And like the incremental like hold rate margins like 4, like that's extremely low. Like Flutter, DraftKings, they're mainly pushing these same game parlays, regular parlays, which are around like 15% all the way to 30%. So this is like driving the mix shift there, and we see the ramp in their data scrapes. Like that already like incrementally just flows straight through EBITDA because it's just the margin.
I'd say one more thing. Management's talking about this a lot. So 100 million comes from the sales and marketing roll off. They have like a bunch of contracts with like basically like stadiums, things like that. And we think like you're still gonna kind of be able to retain share because there's like the natural adjacency of the casino and people who are gonna gamble online. And then I would say like I think the final thing on your point of like is there a promotional space, like that's a good point. But I think like because of what I just mentioned, like management views their business as somewhat differentiated to like Flutter and like DraftKings, whatever, because they're able to kind of drive that cross sell. So they don't have to be as
What do you think is the optimal normalized capital structure for the business from a debt level perspective? So if you were the CFO over the next few years between reduction in CapEx, asset sales, and free cash flow production, how would you think about the optimal mix of buybacks versus debt reduction in terms of capital allocation?
Yeah, I think management quoted a goal, a target goal of 4 times LTM EBITDA. We basically forecasted by 2025 that there is potential to get down to 4.8, given this upside in FCF, and then kind of translate the rest to buybacks. I think stock is trading at a really attractive level for buybacks to kind of occur.
To add on to like your CapEx point, I think that this is where I know like they have like the CapEx cliff coming off from the Danville and New properties being renovated / built. And so I think from like a management perspective, it'd be smart once our free cash flow in digital starts inflecting and becomes more accretive to our bottom line that we are able to spend some CapEx on like renovating our regional businesses, because a huge point about regionals is that a lot of people are just extremely bearish on it. But if you go through renovations, it's not as expensive actually building a new property, but it increases your ADR, which in turn will really create the bottom line. So I think that's another way that.
I'd say one last thing to point here. They don't have that much floating debt. So like honestly, like yeah, that's it. They don't have that much floating debt. Like their debt's like pretty good.
Other questions? Any other questions from the Zoom? Did you do any due diligence going to Vegas to check out the property?
I'm going to Pennsylvania. Sands is there, or I guess now it's big competitor.
Okay.